This default deluge and bankruptcy wave I've been telling you guys about for ages now is starting to play out, and now everybody's talking about it like it's a big revelation. But listen to some of these headlines. Lordstown Motors files for bankruptcy, sues Foxconn over $170 million funding deal. Lordstown Motors filed for Chapter 11 bankruptcy protection early Tuesday. And more to the point, listen to this one. High interest rates and economic uncertainty are behind recent rise in corporate defaults. Corporate defaults rose last month, with 41 in the U.S. so far this year. That's more than double the same period last year, according to Moody's Investor Services. Companies are defaulting on their debt due to the uncertain economic conditions and heavy debt loads. High interest rates have made it difficult to refinance as debt is more expensive. And most importantly, listen to this part, the number of bankruptcy filings in the U.S. this year has also sharply risen to levels not seen since 2010. Expect more of that. I told you that the increased interest rates will have most of their pain yet ahead of us coming up in the coming months, quarters, and the coming year. This is what's all leading us into what's going to be a big recession. Hey, we're working super hard here for you guys, double time in it. If you guys want to help support us, help us get you more great content like this, then consider joining the Peter Leeds Army. There's a link below. If you get the Peter Leeds Army, then you get the special Peter Leeds exclusive, which is a monthly, talking about everything going on with the economy and everything to look at going forward. When it comes to investing, one of the things I always tell you guys about is when there's low activity, low trading volume, you don't need to look too much into the move of the stock, for example, or any kind of economic indicator. If there's a low volume, there's a less commitment of investors who are making that move happen. If you see a stock pop up 20%, but it's on extremely low volume, then just ignore that move. It's very likely to reverse. Same when the stock goes down 20%, 15% on a really low volume, you don't need to worry too much about that. You worry when there's a big amount of volume, trading volume that's bringing the stock down. That means it's a lot of people who think that share should be trading at a lower price. But the reason I'm telling you about that is because that also applies to the overall markets. And right now, there's not a lot going on in the markets. It's really a quiet time. People are watching and waiting. Most people are on vacation or stuck at airports right now.
Into the holiday rush now, and the nation's airports are filled with stranded passengers, many frustrated, aggravated, and sleep deprived.
We just want to go home.
Like today, for example, you're seeing a 0.5% move up or down in the Dow, the NASDAQ. These are small moves that aren't going to be incredibly meaningful. They're not going to affect your life one way or the other too much, which means that this is the absolute best time for you to get positioned in whatever kind of investment you want to gravitate towards. For example, gold prices have been getting absolutely hammered, but they're very likely to bounce back up once the two driving forces that are pushing them down subside a bit. One is that people expected the Federal Reserve to pivot sooner, and now they're saying, no, we're going to do another rate hike or another 2 rate hikes. And everyone's then changing where they're going to put their money. That's temporary until we get past the rate hikes. When we start to approach the point where we're almost done the rate hikes, that's when you'll see the recovery in gold prices. And the other thing that's bringing gold prices down so significantly lately has been the strength in the U.S. dollar. That is also a trend which I believe, and I'm not right all the time, but I'm right a lot of the time, I believe that trend will reverse. I believe the US dollar is destined to have an incredibly weak future. I believe the US dollar is going to be facing a lot of difficult headwinds. And right now, it's doing pretty well, but I believe that that's a temporary thing, and as it reverses, so too will the direction of gold prices. Federal Reserve says 23 biggest banks weathered severe recession scenario in stress test. All 23 of the U.S. banks included in the Federal Reserve's annual stress test weathered a severe recession scenario while continuing to lend to consumers and corporations. The rate of total loan losses varied considerably across the banks, from a low of 1.3% at Charles Schwab to 14.7% at Capital One. Credit cards were easily the most problematic loan product. There's a quote by Mike Tyson, "Everybody's got a plan until you get punched in the face." A severe recession, potentially a depression, is going to completely derail all these stress tests. The stress tests don't take everything into account that they should. For example, a complete slowdown in consumer activity, an increasing inability for people to pay the debts that they owe, even on their credit cards. What happens is that banks are like flocks of birds. They all travel together. They all cut left, they all cut right. When things start going the wrong way, it becomes like dominoes. That's why it's so important for you to make sure that you're set up in the right way. And that includes trying to get down as much debt as you can pre-recession. Start paying attention to how much money you're spending. And I know this all sucks. This is why people don't like watching this message. This is the time to do it. This is a unique moment in history economically. Nothing has ever been close to this. Everything is set up to a point where we had incredibly low interest rates for so long. So many corporations and individuals took on so much debt because it was easier to pay off the debt. And then all of a sudden somebody pulls the rug out from underneath your feet, and now it's all of a sudden hard to pay off the debt that you took on. And this is all before the next rate hike and the next rate hike. And at that point, then people will start talking about the Fed doing the pivot, and then everything will reverse. The dollar will come down, then the gold goes back up at that point. But for now, people are reacting to the change in the mentality that the Federal Reserve is still going to be raising interest rates. And that's giving strength to the dollar, which is putting pressure on things like gold. And with these rates higher for longer, it's just like being dragged across the pavement. The longer these rates stay where they are, the more pain people are going to experience. The entire economy is going to experience. And do not conflate the stock market with the economy. This economy is in trouble. It's been in trouble for a while. I've been talking about it for a while. Now other people are starting to talk about it too, even in the media, such as from those headlines that I read you earlier in this video. If you want to join the Peter Leeds Army, we'd love if you would do that. The link is below this video.